Welcome back. Hope you're having a good morning. As promised, we have Sid Khemka, Head of Research, Wealth Management at Motilal Oswal, who joins us on the show. Hi, Sid. Good morning. Good to see you, Ben. Let's talk about Swiggy. You all have been positive on this space. How do you read those numbers and preference between the two, Eternal as well as Swiggy?
Hi, good morning, Nigel. Glad to be on the show. I think if you look at the key internals of the numbers between Swiggy and Eternal, I think Swiggy came out with a good set of numbers, a better set of numbers. We are seeing that the cash burn has come down. The quick commerce numbers are seeing sharp improvement, both in terms of the average order value, the contribution margin that has seen us that is witnessing an improvement. And I think overall, they are now entering a phase of profitability. The management is guiding for the EBITDA break-even by the first quarter of FY27. So overall, what we see is that while the talks of competition is coming back, but it may not happen in the way we saw in the past. There is a calibrated expansion that they are doing. Plus, the capex that has been done in the recent past, the new dark stores, that will start contributing over the next few quarters. So overall, we believe that this is a company which is now entering the phase of profitability, supported by an operating discipline, improving network efficiency, and the combination of the steady food delivery growth, rising Instamart order values, and the easing fixed cost drag. That makes us positive on Swiggy. We have a target price of 550, giving an upside potential of 31% from current order levels.
Okay, 550 on Swiggy. Since we're talking about new age companies, these days most IPOs that list, and we were having a laugh on this yesterday as well, everything that lists is a tech company these days in India. I mean, you have a computer, I think you become a tech-enabled or tech-focused company. But jokes aside, Lenskart, Siddharth, big debate raging. Which side are you on? Subscribe or not?
Yes, good morning. I think that debate is continuing. So while we like the business model, the growth, and whether you can add that digital thing or not, but I think it's definitely a new age business and e-commerce business. The growth going forward is now largely, I think, is being driven by the offline store. So you may not call it as a pure digital company anymore. So as I said, the debate is on whether the valuations justify the future growth. But one thing is for sure, they built a good brand, they've got a good business model. Online and offline mix is pretty well. We saw that with the same with Nykaa, that a pure digital model, especially in the consumer business, may not do that well in a country like India. So you have to have an offline presence as well, where the consumer can come, touch and feel.
No, Siddharth, no one's debating or arguing against the business. I think, most of us have been probably customers as well at some point in time. No one's arguing with the experience of the business. The only argument is on whether, 200 plus times PE is justified. I think the so-called grey market is indicating that there'll be a 40-50 rupees pop on top of that 402 issue price. The question is, I mean, is it long-term wealth or not? Once all these anchor investors go, when the lock-ins end, what happens then? I mean, if someone were to ask you, I need a great long-term portfolio idea, 3 years plus, should I subscribe to Lenskart or not? What would you say?
So right now, Surbi, I would avoid. As you rightly said, the valuation is still high. I think there is a lot of hype and a lot of investors have gotten, big names have gotten, and hence you could see that pop. But I think the next 2-3 years, the profitability, the growth, sustainability, that could determine. And we have seen some of the other companies, they have already listed and have gone through the grind. And now we have a clear path to profitability, clear path to growth. So a clear answer is no. Definitely, we'll have to wait for a few quarters of delivery and then we'll see whether we have a positive view. But at current juncture, I think there is too much of hype in terms of the valuation and growth that the company is offering.
We take that point entirely. At current juncture, we will obviously have to pay a little more to enter, if at all, given the valuations. But important part would be post-listing what their path to growth would be, and then the street would realign their estimates on that as well. But Sid Khemka still with us. United Spirits, what a solid set that came in from at least, the premium volume part and also the operational performance. The company reported 41% jump that we saw in their profitability as well. What do you make of this one, Siddharth? And even Pidilite, consistent, solid 10% volume growth for the last many quarters, as many quarters as I can remember.
Yeah, hi. So I think United States, we saw a strong beat across in terms of performance and all-time high margins. So I think the efforts that the management has been taking in terms of growth as well as premiumization, that is playing out well. The mix that is improving, and so now you have the P&A revenue, which is now 90% of revenue mix, and the popular segment which has come down. So that is aiding margins. I think the growth was also supported by re-entry into the Andhra Pradesh and strong performance of innovation launches, and so that is something that they have continuously done. So I think slowly and gradually the efforts are paying off in premiumization, margins are improving, and growth is coming back. So some offset of the Maharashtra adverse policy changes is being taken care of by re-entry into a high growth market like Andhra Pradesh. So overall, I think we remain positive on United Spirits, although valuations are a bit on the higher side, but that has been the case always. So that's the view on United Spirits. Pidilite, I think a steady, consistent volume growth. The consolidated revenue grew by about 10%. Underlying volume growth that was pretty strong at 10%. And it is good to see a company like Pidilite again showing strong performance, a consistent compounder in the past. The again challenge here is that with this kind of growth, net profit growth of 9%, valuations which are still on a 1 year forward about 50-60 times. I think we remain neutral, but nonetheless strong numbers from Pidilite.
Okay, all right. Hi, Sid, I wanted to ask you about a couple of other numbers. I think Gravita is something that you track, right? The stock actually has come off drastically from the top, but these numbers look pretty okay. And we know the recycling theme has got, a good runway. What's your view on the stock? And if you track Welspun Corp, well, very, very good set of numbers. And we had explained the company earlier. They are one of the beneficiaries of Trump's tariffs, of Mr. Trump talking about drill, baby, drill. And balance sheet as well is looking spectacular. Any view on both these names?
Nigel, we don't track Welspun Corp, so unfortunately we will not be able to comment there. But Gravita, yes, definitely we do have a view, and as you rightly said, there is a lot of focus on recycling. A lot of new names have got listed in this space, and they have done well. So even if you look at Gravita, the numbers reported, the operating performance was above our estimate. Revenue grew about 12%. Margins saw a marginal uptake, and we have seen the net profit growing by 33%. Even in, if you look at on a segmental basis, the lead business that grew about 11%, there was a 5% volume growth. Aluminium business saw a sharp improvement of 37%. Volume grew 27%. So overall, we continue to like Gravita. We believe that the company has the capacity that is getting expanded, and this focus on value-added products, plus the improved domestic scrap availability, that because of the regulatory support, that should lead to a good 25-30% CAGR in earnings over the next 2 years, and hence we continue to remain positive. We have a buy rating and a target price of 2,000 on Gravita.
All right, and just finally before we let you go, Latravenues Tech, Ixigo, was at one point down nearly 18-19% yesterday. The results that came in, there was a reported EBITDA loss, but if you adjust for the non-cash ESOP expense, there was a 28% jump in the EBITDA, and the cash profits, or rather, the operating cash flow, also jumped by a good 30%. What do you make of these numbers? And the second half, the travel theme, the OTAs, etc. What do you make of this stock, and is there anything else that you like here?
Mangalam, we don't track Indigo, unfortunately, but the entire travel tourism theme that has done pretty well in the last couple of years post-pandemic. I think the domestic tourism has picked up nicely. So we are mostly tracking the hotel space, and there we like Indian Hotels, Lemon Tree. Those are the two preferred picks there. And the third idea that is a quasi-play is Indigo, Interglobe Aviation. Again, consistent capacity expansion, newer cities being connected in India, and also the future growth for Indigo is coming from the international destination. So overall, I think hotels and aviation, these are the two preferred picks from us on the travel and tourism side.
All right, Interglobe Aviation, Lemon Tree and Indian Hotels. Thanks a lot for that. That's all for today. Have a good Friday and a good weekend. We speak to you next week as well. Sid, thank you.